All right. Good morning, everyone. This is a revision session for your Advanced Financial Management Paper 2, Module 10. Now, we had done this particular entire module in 6 different sessions earlier. Thereafter, we also have done revisions earlier.
Amit, sorry to correct you. We
Yes, sir.
normally call it as a chapter, not module.
Okay, sir. Chapter.
Okay. So module gave a wrong interpretation. It means the complete study material.
Yes, sir.
Okay.
So in our study material, we have chapter 10, foreign exchange exposure and risk management, which is what we are going to revise today. So first and foremost, to start with, the entire module or the chapter is essentially going to be covered in the form of, first and foremost, why do you need Forex, right? So what is foreign exchange? So foreign exchange is nothing but the currency of another country, which you may be needing for the purpose of various occasions, right? What those occasions are? Essentially, first of all, if I want to make any investments abroad, if I want to do any trade abroad with international countries, then I would need currency of their country, right? In order to be accepted. Or alternatively, there could be another currency which is equally acceptable to both the countries. So, what are the various reasons for which we may essentially need foreign exchange? So, let me take you back to our first session. Why do we need foreign exchange as such, or Forex? So there may be multiple types of transactions that involve foreign currency, right? For example, if you are going to borrow in rupee or in foreign currency, you want to essentially trade in foreign currency. Maybe I have a certain exposure or a certain liability in foreign exchange, and as a result of that, I probably may be required to hedge my foreign currency exposure. As you know, it's a dynamic economy. As a result of that, foreign exchange rates keep on changing, right? So today, what is available to me at, say, for example, 10 rupees may be available at a different rate, maybe 2 months or 6 months down the line when my obligation is set to be due, right? The second one, or the other way, could be when I am essentially inviting investments into India from abroad. Now, as we know that India has been a developing economy for some time, and one of the main shortages for us has been capital investment. Now, if you don't have capital investment, then the best way to go ahead is to invite foreign capital into India. That is foreign direct investment into India. Or these days now, India has come a long way ahead. So as a result of that, you find a lot of the companies like Mahindras and Tatas, etc., who are investing in companies abroad, right? They are acquiring various companies abroad. Again, for that as well, you need foreign currency, right? So setting up plant in India would require essentially foreign currency for a foreign player. Similarly, if say Tata's is essentially acquiring a particular plant in, let's say, UK, United Kingdom, then in that case, they would also need foreign currency, right? So when we are doing these transactions, we need foreign exchange, right? Now, the moment we say I'm going to essentially buy a particular currency, that brings me to a very important and very easy question. At what rate, right? At what rate? So how do I convert a rupee into, say, for example, convert rupee, that is Indian rupee, into USD? So how do I go about doing that? So say, for example, today I am essentially purchasing 100 rupee, or today 1 USD is equivalent of, let's say, for example, rupees 80, hypothetically. If 1 USD is equal to rupees 80, that means the purchase price of 1 USD is rupees 80. So how do I essentially go about understanding these currencies? So if I want, say, for example, to buy 100,000 of USD, I will essentially need to pay 80 into 100,000, which is going to be 8 million, right? Now, if I have to essentially say, for example, do some transaction, I'll give you a very simple example. Let's say, for example, I have to essentially invest in a stock in Tesla. So how do I go about this? Say, for example, I want to invest in stock in Tesla. Now, Tesla stock is going to cost me, say, for example, I want to invest $100,000. So $100,000 is going to cost me how much? As I said, it's going to cost me 80 into 100,000. Am I right? So it is going to be 8 million or 80 lakh rupees. Now I'm going to take this particular 100,000 and invest in stock in Tesla. So how do I go about doing that? Say, for example, the cost of one share of Tesla today is, say, for example, $50. So in other words, I will get 100,000 divided by 50. So I'll get how many shares over here? I will get 2,000 Tesla shares, right? Now, when I have this particular 2,000 shares, next is how do I essentially, I have made investment in Tesla shares. Say, for example, I hold this particular investment for a period of 1 year. So what will be the value at the end of 1 year? What will be the value at the end of 1 year? Say hypothetically, these shares have appreciated by 20%, right? And during the year, so price at the end of the year is, say, for example, $60, right? Further, they paid during the year dividend of $2.50. So what is the total value that we have earned over here at the end of 1 year? So value will be how much? For us, it will be $60 per share, plus I have also received dividend of 2.5 per share multiplied by 2,000. So in other words, I will have 62.5 into 2,000. So that is going to come to 1,25,000, right? Now I have got this money in dollars. Remember, these are all USD. So how do I bring it back into India? I will need to again convert this back into India. So I need to essentially convert these holdings into rupees, that is INR. So how would I go about doing this? I'm going to now essentially sell this particular share, sell this particular share in, first of all, USD market. So I'll get 125,000 in total. And thereafter, I'm going to sell these dollars into Indian market, right? Because I have dollars, what I need is INR. So I'm going to essentially sell this dollars into INR. Now, say, for example, the rate prevailing in India now, say, for example, 1 USD is equal to INR 85 rupees, say, for example. So in that case, I would get how much INR? By selling, sale of USD 125,000, I'm going to get 125 into 85, right? Now, this amount, when it is converted into INR, you can see the rate of return I can essentially earn can be compared over here only when I am essentially identifying the total value which I have earned. How much is the total value which I have earned? I have earned over here. You can see I have earned over here essentially 1,06,25,000. What was my original investment? My original investment was 80 lakh rupees. I have earned 1 crore. And now I can calculate rate of return, which is 1 crore divided by original investment, which is 80 lakhs, right? So I will say essentially 1 crore divided by 80 lakhs into 100. And I will get the return percentage, right? Yes. So it is 32%, right? It is 32% return. 1.32. Yes. So we have earned total excess of how much? Total excess is essentially 1 crore 6 lakh 25,000 minus 80 lakhs. So the excess is 26 lakhs 25,000, right? And if I want to calculate return, I can say 26 lakh 25,000 divided by 80 lakhs into 100. So I get 32.8125% return. Now, this particular investment opportunity becomes possible for me only when I am essentially able to do transactions in foreign exchange, right? So this essentially brings us to a very, very important concept of foreign exchange exposure and risk management. So first of all, what are the exposures in this entire transaction? I have invested over here rupees in place of I have purchased USD. The risk would have been essentially if USD would have, say, for example, depreciated vis-a-vis INR, meaning, say, for example, if 1 USD, which is I have purchased for 80 rupees, what if at the end of the year, that same USD was available at 70 rupees? Now, it is not possible for me to determine what will be the rate, whether it will be 70 rupees, 75 rupees, or 85 rupees at the end of the year, right? So there is a particular exposure or a risk which I am carrying. Having said that, I also got an opportunity as a result of this particular transaction to invest in a foreign stock. I invested in that foreign stock when I converted back. Now, since in this case, the USD appreciated in comparison to INR, thus I made even more profit, right? So how much of this profit is essentially only and only because of foreign exchange depreciation of INR? Now, please remember there are two currencies, right? USD and INR. So one has appreciated, the one has depreciated. So which one has appreciated over here? You have USD, which has appreciated from 80 to 85. Now, that brings us to another question. That is, what is base currency? Which is base currency over here? Base currency is the currency in which terms we are expressing the entire exchange. So in this case, USD is the base currency because when we are expressing it, we are expressing this INR per USD, right? So USD is the base currency over here. Say, for example, if I want to express the same with INR as the base currency, then in that case, it would have to be USD upon INR, right? How does that essentially come to? So 1 USD is equal to 85 rupees. So it will be divided by 85. So now we are expressing USD rate is 0.011765. This is essentially the rate of USD in INR terms, right? So we are essentially saying that for a USD upon INR, meaning 1 INR can buy how much of USD? It can buy only 0.011765 of USD. Are you with me? Similarly, over here, when I say it is 85 rupees, right? 85 rupees upon 1 USD. So 1 USD is able to buy 85 rupees. Thus, the exchange rate is 85. So USD here is the base currency. In the other one, INR is the base currency, right? This is how you essentially express a particular currency code. This is also known as a difference between direct code and indirect code, right? Now, we have expressed these aspects and we have learned about these concepts. I will go slightly faster in this case, considering it's a revision. So I'm assuming you also have gone through it. Or if you have not already started studying, then in that case, this session would essentially help you how to go about planning your study, right? So once you have your basic understanding in place about foreign exchange transactions which are required to be done, the other aspect which comes into play is how do I essentially do a particular transaction where I have to essentially learn about the return which I earn, right? So as I mentioned earlier, we have already calculated over here the return, which is 32.8125. I want to break up this particular return into two parts. One is the return which is earned due to foreign currency and the return which I have earned on the investment. So how do I do that? 125,000, if I take it into 80, for example, that would be at the original rate at which I had acquired. That means 125,000 into 80. So that would have been the value, that is 1 crore, which I would have essentially secured had the exchange rate would have been same, right? So in this case, my profit would have been 1 crore minus 80 lakhs, right? That comes to 20 lakh rupees. And in which case, my profit percentage or rate of return would have been 20 lakhs divided by 80 lakhs. In other words, 25%, right? This would have been 25%. So then the balance 7.8125% is essentially coming because of the appreciation of foreign currency, right? USD has appreciated vis-a-vis Indian rupee that is, and that is the reason you have this particular appreciation coming in. Now, the other important concept is when do I divide or when do I multiply, right? Because here I have done multiplication on one occasion, 125,000 into 85. And then there are other occasions when we may also need to divide. So how do we decide when to multiply and when to divide? Anyone has any ideas? Yes? No? All right. So I will in that case continue. Say for example, with the help of an example, let's say if GBP is your Great Britain pound, right? So if GBP 50,000 is there, and I know for a fact that 1 GBP is equal to $1.7650. So how much will be 50,000 GBP into USD? So here, what do I need to do? 1 GBP is 1.7650 USD. So 50,000 GBP will be turning into how much? Here it is a simple case of 50,000 multiplied by 1.7650. Am I right? So here what we are doing is we are doing multiplication. Am I right? So I get 88,250 USD. Say for example, if it is Japanese yen. Japanese yen, say for example, it is 10 lakhs or 1 million Japanese yen. Now, INR 1 is equal to Japanese yen 2.3650. So 10 lakhs or 1 million Japanese yen will turn into how much or how many rupees, should I say? Yes. So INR will be how much? Here, can we do the multiplication again? Can we do the multiplication again? The answer is yes or no. We can't do that, right? Why we can't do that? Because INR 1 is JPY 2.3650. Japanese Y is 10 million. So you can do a simple calculation over here, right? If you do even cross multiplication, you would come to know 10 lakhs into 1 divided by 2.3650, right? Because here we will have to divide. So I will essentially divide it and say it is 10 million, or rather 10 lakhs divided by 2.3650. So I get 422,833, right? So what does it tell us? What is the principle it essentially lays down for us? Yes. What is the currency being quoted as when we are talking about INR to JPY? So here currency is essentially quoted as JPY to INR. While here currency was quoted as, it was 1 GBP, right? Upon 1 GBP is equal to dollar. So this was USD upon GBP. So when I am going from GBP to USD, meaning you are going from base currency to the upper currency, reference currency over here. So you are going from GBP to USD, I will multiply, right? That is what I did over here to find USD, right? From GBP to USD. So up the exchange rate, you essentially multiply. When you go down the other way around, remember this is Japanese Y, which you already had, Japanese yen, right? This currency exposure or the exchange rate is expressed as JPY to INR. Am I right? So here in this case, when you are going down, it is divide. So up the rate, multiply, down the rate, divide. Okay, I repeat once again. Up the rate is multiply, and when you are going down the rate, it is essentially divide. Okay. So in this case, as I said earlier also, INR is our base currency, and Japanese Y or Japanese yen in this case will be considered as our price currency or the pricing currency, right? Similarly here, GBP will be considered as base currency and USD will be considered as price currency, right? All right. We go to the next concept being, how do you calculate percentage change in price currency? How do you calculate percentage change in price currency? Yes. Percentage change in price currency. When I say if my currency rate is expressed as, say my currency is expressed as INR to USD. So USD is my base currency and INR is my price currency, right? We already have taken one example. Which is that example? we took this particular example, right, where we essentially found out that out of the rate of return of 32.8125, 25% was only because of the actual return had exchange rate not happened. And we try to essentially justify over here that the rate of exchange was 7.8125, but we had not calculated over here. So let's calculate that over here now, right? So that we have a clear understanding of what is the percentage change in price currency. So how do you calculate percentage change in price currency? So you were earlier able to buy a dollar for 80. Now you are buying for 85. So for you, there is a loss. Am I right? For us, it's a loss. The currency has depreciated, right? As far as INR is concerned, INR has depreciated. So when I am calculating 80 minus 85, I will divide this by which currency now? I'm going to essentially calculate the depreciation for pricing currency by dividing with 85. Right? So how did I get that? Yes. I can multiply this with 100 and I will get in percentage terms. So it's a negative 5.88235 in today's terms, right? So in other words, this is also being referred to in the module or your chapter per se, chapter 10. It is spot rate, right? So you will essentially call this as S0 minus S1 upon S1, right? This is nothing but the rate at the beginning minus rate at the end upon rate at the end. This is the percentage change in the pricing currency. Remember, this is percentage change in the pricing currency, right? Percentage change in pricing currency. Now, if I say want to calculate the same as appreciation, then how do I go about doing that? Then how would I go about doing this? Because if I'm trying to calculate percentage change in base currency, for example, percentage change in base currency. This time we are going to calculate in base currency. And which is the base currency? Base currency is dollar, right? Base currency over here is dollar. Base currency is dollar. So how do I calculate percentage change in base currency? So base currency was how much earlier? Yes, it was able to fetch you how much return? I have to essentially change it, right? Yeah, now you are able to get how much? 85. Earlier you were getting 80. Your currency has become more stronger. You are getting more value for your currency. Am I right? So here I'm going to essentially say it has to be 80. So you can see this is 6.25 currency percent change in the base currency. 80 became 85. So as far as the base currency is concerned, it has appreciated by 6.25. On the other hand, your price currency has depreciated by 5.88235, right? So how do you calculate this one? Yes, here we calculated saying it is S1 minus S0 upon S0. Am I right? All right. Now that we have calculated appreciation and depreciation, let us try to calculate how to go from appreciation to depreciation. Right? Let me take a different example. Say, for example, there is a currency which has appreciated by 5%. Okay. So let me take it as INR upon USD. Right? It was earlier, say, for example, 100 rupees. This is just for example purposes so that it is easier for us. Right? And then it became INR upon USD became, say, 105. Right? This was maybe at the beginning of the year. This was at the end of the year. So in a year, you can see INR to USD has become 100 ka 105. So the currency which has appreciated over here is USD, because now it is able to get more of INR for the same amount of USD, which is 1 USD. On the other hand, INR has depreciated, right? So how much has USD essentially appreciated? 105 minus 100 upon 100, so it is appreciated by 5%. Am I right? So how do I convert this from appreciation? So USD has appreciated by how much? By 5%. How did I get 5%? It is 105 minus 100 divided by 100. So 5%, right? So if I multiply this with 100 to get the answer in percentage, it is 5%, right? Now I want to find from the appreciation of 5%, I want to find how much is the depreciation in INR. So can I find from appreciation to depreciation? So INR has depreciated. Now remember here you have the numbers available to you, 100 and 105. But what if these numbers are not available to you? The only thing which is mentioned is that USD has appreciated by 5%. And now calculate INR has depreciated by how much percentage? So how would you calculate that? So that is essentially going to be 5 divided by, remember when we calculated depreciation on the pricing currency, we divided it by S1, right? So what is the S1? Assuming over here, since it is in percentage, so in the divisor, I will say it is 105 into 100 to get the answer in percentage. So I get INR has depreciated by 4.76%. I repeat once again, what have I done over here? I have taken from appreciation of one currency to depreciation of another currency. I am told USD has appreciated by 5%. So calculate how much has INR in reference to the same depreciated by. So how do I calculate that? USD has appreciated by 5%. So I will take in the numerator over here. I will essentially say it will be 5 divided by 105 into 100. This is how I went about calculating how INR has depreciated. So 5 is the appreciation, because that is also going to be the depreciation for INR, right? So numerator is not going to change except for the sign. So 5 is what USD has appreciated. So obviously that is a value which has been lost by INR. But the denominator is going to change. For USD, when we calculate, we always take the S0, right? The original rate to calculate the appreciation. But for the depreciated currency, you always take the S1, right, in the denominator. And that is why you get 4.761905. Now, with that concept in mind, what are the different aspects we have already covered in this particular aspect? The first and most important aspect now that becomes is, how do I convert? And another opportunity which comes across to us is calculating something known as cross rates. What do you mean by cross rate? Say, for example, I have been provided that USD to INR rate is, say, for example, 80 rupees. I'm sorry, this is INR to USD. Yes. INR to USD is 80 rupees, right? Further, we are told that GBP to USD is, say, for example, 1.75. Now, I want to buy, say, for example, 100,000 GBP. You want to buy 100,000 GBP. So, how much INR will be required? Yes. So, how do I go about calculating this? INR to USD. So, that is 80 rupees. GBP to USD is 1.75. And you need to buy 100,000 GBP. Assuming over here there is no direct quote available. What do you mean by direct quote? The two currencies, if they are directly exchanged, right? So your central bank essentially tells you these are the currencies against which you have direct quotes. So Indian currency is generally having currently 12 such direct exchange quotes against different currencies. For the other all currencies across the globe, it is always the cross rates which are calculated to express the currency rates. Okay. So how do you essentially determine over here, assuming over here, there is no direct quote available between INR and GBP. Then how do you go about converting INR to GBP? I want to buy 100,000 GBP. So what is the rate, first of all, for INR to GBP? Yes. Now, since over here, your life is a lot easier because I have expressed it in such a way that your life is a lot easier. The reason being, you can see over here, in both the cases, the base is 1 USD, which basically easily allows you to compute that it is INR upon GBP will be how much, right? If you want to find INR to GBP, you'll be able to find this very easily. INR to USD is 80 rupees and GBP to USD. So 1 USD is equal to 1.75 GBP over here. This is 1 USD. Remember, I have expressed this where USD is the base rate, right? So 1 USD is equal to GBP 1.75. Now that essentially means, what is the rate over here? Yes, 1 USD being the common factor. So 1 USD is equal to 1.75 GBP and 1 USD is equal to INR 80, meaning 80 rupees is equal to 1.75 GBP. 80 rupees is equal to 1.75 GBP. Are you with me? That means the rate is 45.71429. What we did was 80 upon 1.75. Now let me change the same rate slightly differently. Say, for example, I change this rate slightly differently. Let me put it over here. And here I am going to say it is, say, for example, the other way around. It is USD upon GBP. Now what happens? Can the same calculation still stand now? It will not stand now. Why is that so? Because earlier you had the same base currency, right? So it was a lot easy. INR 80, GBP 1.75. So basically, USD being the common factor automatically gets cancelled off, and what you are left with is 80 rupees is equal to 1.75 GBP, right? Now it's slightly different. What is the difference now? INR upon USD. Here USD is the base currency, and here USD is the pricing currency. So 1 GBP is equal to USD 1.75. Now, how do I go about calculating INR to GBP? Yes. So what I will do is essentially I will say here INR upon USD multiply by USD upon GBP. Am I right? Am I right? Why am I doing this? I am substituting one value in another. How do I do this? Now pay attention again. It's INR to USD. So USD is the base currency, right? It is INR 80 per USD, and USD here being the pricing currency. Remember, when you are going from USD to GBP, I am going to essentially say this is 80 USD to GBP I want to go, right? So how do I go about doing this? 1 GBP will be equal to how much? Because 1 GBP is 1.75 USD, right? 1 GBP is equal to 1.75 USD, right? And your INR to USD rate is 80. So effectively, the answer that you will get is 80 into 1.75. So I get 140 rupees per GBP, right? This is how you essentially calculate the cross rates. Now here, once you have got the rate, you can easily find how much you need to buy, 100,000 GBP. Here you can see the rate you have found out is 45.71. So just multiply 45.71 into 100,000 and you will get 45,71,429, right? Similarly, here if you have to buy, now the rate is 140. So the same thing I need to do over here as well. And that is, I would need 140 multiplied by 100,000. So it will become 1.4 crores. Right? Now, one of the very important concept for us is how do we go about doing these exchange rate forecasting, right? Because these exchange rates, as you can see, while it is not in my control, given the past rates which have happened, what is happening as of now today, to what information is available to us in the public domain, can I essentially anticipate what will be the rate expected in the future? So what are the different rates or different methods for exchange rate forecasting? So what are the different techniques of exchange rate forecasting? So first is technical forecasting. So how do I go about doing technical forecasting? What do you mean by technical forecasting? Yes, any ideas? How do we go about doing technical forecasting? Yes, Mr. Shailendra, Ms. Kushi. All right. So technical forecasting is basically when you are essentially looking at the technical data, right? So just like you have technical analysis, you try to do what is the anticipated based on whatever has been the past trend. So you try to do technical forecasting based on that. Next is fundamental forecasting. Fundamental forecasting, again, it comes based on what are the fundamental values of the underlying currencies and what are the GDP movements which are expected to have currencies. Third is market-based forecasting. Now, this is based on the demand and supply of that particular currency. Now, in a lot of the cases, you have the information or the data available about what are the different transactions which are happening in the futures, forwards, what is going to be the required exposure, etc., etc. So, as a result of that, I have some sense of what is going to be the demand in future about a particular currency. Based on that, you can do certain market-based forecasting. And then last one is mixed forecasting, which is nothing but utilizing not one, but a mix of one of the other three methods, right? So you take essentially one plus maybe one or all three methods to a certain extent to derive a mixed forecasting method. Now, important aspect for us now becomes what is exchange rate theories. So what are the exchange rate theories which we have learned in this particular chapter? First is interest rate parity. That is also known as IRP. Now, what is the meaning of interest rate parity? Say, for example, if India is giving you 9% as the interest on a bank FD, for example, and US is giving you 2% interest, right? Now, what does this essentially tell us? There is a difference in the rate of interest on domestic and on a foreign deposit, right? Say, for example, this is all I'm talking about deposit rate in India and US, right? So India is offering you 9%, US is offering you 2%. So why is somebody generally, in the absence of any information to the contrary, if the two countries are going to have parity meaning they are at balance, right? So if one is offering more, the other also has to offer the same, but then US is paying 2% only, India is paying 9%. So interest rate parity essentially says that this extra 7%, which I am essentially paying out to the deposit holder in India, considering that say 100 rupees over here, try and understand this. If the exchange rate today is 100 rupees for 1 USD, right? A year later, this person is going to get over here 1.02 as the future value of the deposit rate. On the other hand, an Indian guy will essentially receive how much? 109 for the deposit which he has made in India. Now, the interest rate parity says since these two values have to be at parity, right? Because today's exchange rate is, this is my current exchange rate. Exchange rate currently is 1 USD is equal to 100 INR. So that same parity has to be maintained, which essentially means that which currency is going to depreciate over here? INR is going to depreciate, right? That is the principle which is laid out under interest rate parity. Similar concept is also being laid out in the second method, which is inflation parity principle. Am I right? Or which is also known as purchasing power parity. Purchasing power parity. Right? So what do you mean by purchasing power parity? Same concept, but the difference being here, now we are focused on inflation rates instead of interest rates. Right? So when we say that a particular currency is in, say, for example, in equilibrium, what does that essentially mean? That your current spot rate, which is there, is basically equal to whatever is your sectoral price and sectoral share constant, right? Sectoral share constant. This is, sectoral share constant multiplied by price of a particular commodity in domestic market upon price of the same commodity in foreign market. Right? So as long as your sectoral price and sectoral share are constant, right? Your price in domestic market upon price in foreign market is basically going to give you spot rate of the exchange currencies. Right? So in other words, if I am saying my spot rate is this, so what is expected to be my spot rate? Expected spot rate. So what is my expected spot rate? My expected spot rate, which is S0 plus 1 plus inflation. This is I, inflation in domestic currency, upon 1 plus inflation in foreign currency. Right? So this is your spot rate into 1 plus ID upon 1 plus IF. Let me give a tangible example on this. Then it becomes easy to remember. Right? So say, for example, again, I will take, let's say, INR to USD is 80 rupees. Okay. Further, we are told inflation in India, inflation in US. Say inflation in India is expected to be, let's say, 7%. And inflation in US is expected to be, say, for example, 1%. So how will this essentially give me the expected spot rate? So what will be my spot rate in future? Current, remember, it is 80. So what is my expected spot rate? That is S1, right? S1 is your expected spot rate. So what will that be? Yes. Spot rate is 80 multiplied by 1 plus 7%, because that is domestic currency, upon 1 plus 1%, which is foreign currency. So I'll get 84.752475. And why am I getting this? Because you can see over here, while the current spot rate parity or equilibrium price is 80 rupees for USD, Indian currency is going to depreciate by 6% more compared to US. This is what purchasing power parity principle tells us. Right? All right. All right. Now we come to the another concept. There is something known as two-way quote of currencies. Right? What do you mean by two-way quote? What do you mean by two-way quote? Say, for example, if I want to buy INR upon USD, right? So I'm given the quotes as, let's say, 80 to 82, for example. This is how the two-way quote generally gets expressed. So what is the meaning of this? What is 80 and what is 82? Yes. So these are considered as two-way quotes, meaning they are often referred to as bid and ask price, right? Bid price and ask price. So what do you mean by bid? This is the price at which your dealer will purchase USD from you and will give you 80 rupees. 82 is the price at which he will sell the dollars to you. So if I want to, I as an ordinary person or a company or an investor, I reach out to the forex dealer or a banker and I tell them I want to buy USD. They will essentially sell it to me at 82, right? On the other hand, if I try to sell it to them, I have dollars because I have earned dollars and I want to sell those dollars to the bank. Then the bank is going to offer me 80 rupees, meaning they will buy my dollars at 80 rupees, right? So this 80 rupees is called bid, right? Bid, or in other words, this is the price at which the bank sells its currency, right? Sells the currency. On the other hand, you have ask price. This is the price at which bank is going to, now it is going to bid, is essentially it is going to sell which currency? It is going to sell you which currency? Here, remember, bid is basically at 80, it is going to buy dollars. So it is going to sell you what? It is going to sell you INR, sells INR, right? On the other hand, if here you are saying it is asked, meaning this is the price at which dollars will be sold, which means you are essentially going to end up buying INR. Okay? So bid price and ask price. So generally these are expressed as bid and ask. This is the price. Bid is the price at which the bank will buy your foreign currency and give you INR. Right? And sorry. So at bid, it will essentially, you will be able to sell, sorry, my mistake. So it will be able to sell USD in this case, right? So at bid price, it will sell USD, or in other words, buy INR. And here it is going to buy USD, or in other words, sell INR. Try and understand the difference between the two concepts, right? So at bid, basically what I am doing is at 80 rupees, I am going to buy dollars from the banker, right? And I am essentially going to buy dollars with INR. So bank essentially sells you USD. Bank sells you USD and you are able to buy it with INR, right? So it can be considered as bank is selling USD, or in other words, bank is buying INR from you. Right? Similarly, if you are talking about ask price, bank over here, who is buying the USD now? Because at 82, it is going to sell USD. Let me remove this. Maybe it is causing confusion. So at 80 rupees, just remember simple thing. Bid is basically the price at which it is going to buy the USD. Bank, so this is for the FX dealer or banker, right? So they are going to buy at the bid rate, and ask is they are going to sell to you at 82. So they'll buy from at 80, sell at 82. What is the difference? Difference is known as spread, right? Difference is known as spread between 82 and 80. All right. Okay. So generally, bid price, please remember, bid price is always lesser than the ask price, because obviously banker is also a business. It's not in the charity business. So the foreign dealer or the forex dealer will essentially need to keep his margins, right? So this margin essentially ensures that he is going to buy at a lesser price and sell at a higher price. So generally you will find bid is always lesser than the ask price. All right. Now, let's say, for example, I have a quote which is given to me. Say, for example, there is a direct quote of currency. What is the direct quote of currency given to me? Let's say 1 USD is equal to INR 80. Okay, this is a direct quote given to me. What is the indirect quote? What is the indirect quote over here? When I'm trying to express the other way around, right? So 1 INR will be equal to how much? It will be 1 upon 80 USD. Am I right? Right? This is called indirect quote. Is $1 upon 80, right? So this is a simple quote which is given to me, which I have expressed as direct and indirect. Now in the two-way quotes also, you have something known as converting two-way quotes into indirect quote. So you may have a direct quote given to you. We have to convert that into an indirect quote. So how would you do that? Say, for example, I am taking the same example over here. Let's convert. This is a direct quote given to me, INR to USD of 80, 82. This is a two-way quote, ask and bid price given to me. I want to convert this into indirect quote. So this is direct quote, right? This is a direct quote. How do I convert this into indirect quote? Or indirect two-way quote. Remember, now it is going to be USD upon INR, right? I'm trying to express it the other way around. So whenever I'm trying to do this, remember, it will be the reverse. That is inverse of this, right? So earlier I had 80 to 82. Now I will have 1 upon 80 and 1 upon 82. But the question arises, which will be the base rate and which will be the bid rate, which will be ask rate, which will be bid rate, which will be ask rate. So try and understand 1 upon 82 is a smaller value or 1 upon 80 between the two. So 1 upon 82 obviously is going to be a smaller value, right? So here now when you are converting, your ask price will go into the bid price, right? And it will go into the denominator. So in other words, it will become 1 upon 82 and you will have over here 1 upon 80. So when I am converting my direct two-way quote into indirect two-way quote. You can see over here my ask price. I do the inverse of the ask, that will become bid, and inverse of the ask will become bid price. Inverse of bid becomes ask. Inverse of ask becomes bid. Is that clear? Okay. This is how you convert. This is how you convert. This is called conversion of two-way quotes. Okay. All. Now, the next concept that we are going to start with is, what is the difference between spot rate and forward rate? So what do you mean by spot rate? What do you mean by spot rate? So spot rate is the rate prevailing today, currently, right? So it is applicable for any transactions that you are doing, buying or selling currencies, that is buying or selling currencies at spot, meaning currently, today, right now. That is called spot rate. Now, obviously, as a result of that, you can see the corollary is going to be, what do you mean by forward rate? So what is forward rate? Applicable for buying and selling of currencies, buying or selling currencies at future specified date. That is essentially forward rate. It may be a month, 2 months, 3 months, depending on whatever is your obligation. You may need this particular rate for future date, obviously not today, right? Now that essentially tells me what is forward rate. Now forward rate, remember, I go to the bank today and I tell them I would need $100,000 because I have a certain obligation, a certain liability to pay in future. Maybe 6 months down the line, I have to pay $100,000. So what is the forward rate today? So they will essentially give me a forward rate, which is nothing but an expected spot rate, right? So they will essentially convert the spot rate into a forward rate based on their methodology or expectations, and they will communicate to me the forward rate. Having said that, is it necessary that future price of the currencies will be the same as the forward rate which is given to you? The answer is no. The only certainty that it provides you is it basically helps you in restricting your obligation. Your liability is essentially limited if you essentially go for a certain forward and you fix that particular contract. Now that brings me to a contract known as forward exchange contract, right? Forward exchange contract. Now, as the subject name itself is risk management, remember, I want to essentially cover my foreign exchange exposure and risk management. So for risk management in future, what the currency rates may be, I do not know. You have seen how currency rates have changed in the last 1 year. USD has become now very expensive. It has become it is touching almost 88, 89, right? So I want to avoid such uncertainties where future your tariff war or whatever it essentially comes in future. I don't want to take that extra risk of my obligation. So as a result of that, I essentially want to manage my risk. I want to essentially know with certainty what is going to be my obligation. So I enter into a forward exchange contract. Now what that does is it tells me that I'm going to essentially buy a certain currency in future at agreed rate, right? When is this going to happen? At future specified date, right? But this particular rate is agreed today. And that is the reason it is called forward exchange contract, right? This is nothing but it is an opportunity to hedge your foreign exchange risk, right? Now, I need to know over here what is the premium or discount on forward contract. So your forward exchange contract can be at premium or at discount, right? So how do you calculate premium or discount? Premium or discount on forward contract. Now, please remember, whenever we are talking about premium or discount, we are talking about premium or discount in comparison to spot rate, right? So essentially, my calculations over here would have to factor in the forward rate. So I will say essentially forward rate minus spot rate upon spot rate upon spot rate multiply by 12 months, right? So this basically tells you what is the premium or discount on an annualized basis, right? Whatever is the premium or discount on an, if the prevailing rate, the spot rate today is 80 INR to USD currently, so S0 is 80. This is INR to USD, okay? And let's say your forward rate today is, let's say, 84, right? Again, INR to USD. So in that case, what is the premium or discount which is going on? Yes. What is the premium or discount going on? Now F0, I will make it as F1, right? So at the end of 1 year, forward rate is 84. So now let's calculate over here. It is 84, which is forward rate, minus spot rate, which is 80, divided by spot rate, which is 80. Now, since this is already for a 1 year, as I mentioned over here, then I don't need to multiply it with 12 months. Had it been, say, for example, for 3 months, 4 months, etc., then in that case, we would have annualized it, right? So I get 0.05, or in other words, 5%. So this 5% is premium or discount on forward contract, right? Okay. Now, that brings me to the very important aspect of our entire chapter, which is how the different forward contracts would essentially terminate. We have already seen now how it comes into being. What is your main objective? Your main objective is obviously I want to curtail my risk. And that is the reason I would go for a forward exchange contract. But once you have a forward contract coming into being, what are the different ways in which a forward contract terminates, right? So termination of forward contract is what is going to happen. In different situations, the concept is different, right? So computation is essentially going to change with that difference. So we will take that because it is going, that particular concept will take slightly longer, because then with examples, it takes slightly longer. So we'll take a break right now. And then after the break, we will start with the different modes of termination of contract and how the value essentially gets affected by it. Manish ji? Hello? Manish ji? Can we take a break?
Okay, sir. Sure. Yes, the break starts.
All right. Thank you. All right. So we last discussed about premium or discount on forward contracts. Now, before we go on to the next part of forward exchange contracts and its termination, one of the other aspects, which is also very important for us, is existence of arbitrage opportunity. How do you know whether there is an arbitrage opportunity available? So, for example, if I have, let's say, for example, I have information given to me that spot rate, let's say, is 80 rupees. Again, I am talking INR to USD. I am told interest rate for INR and interest rate for USD. Say, for example, interest rate to INR is 9% and interest rate to USD is 2%. This is the interest rate, right? Now, how do I find what will be my fair forward rate? So how do you find what will be your fair forward rate over here? What do you mean by fair forward rate? Based on my interest rate parity principle, I will try to find what is my fair forward rate, right? So how am I going to calculate that? Fair forward rate is equal to, remember the formula that we had seen earlier as well? So it will be spot rate multiplied by 1 plus interest rate in your domestic currency, so that is 9%, divided by interest rate in foreign currency, which is 2%. Right? Now, what is that rate going to come to? So I'm going to say over here, my spot rate is 80, right? So my fair forward rate is 85.490. Now, what if my actual forward rate, this is the rate which is offered to me by the banks. So if I go to the bank, bank is telling me I am willing to offer you for 84.50. My fair forward rate says it has to be 85.49 will be the fair forward rate, meaning $1 will be costing 85.49 rupees a year from now. On the other hand, my banker is offering me actual forward rate today that they will essentially give you this $100,000 at the end of the year at 84.5 rupees. So what is going to be costing 85.49 according to you as per fair forward rate is available to you for 84.5. Now, the question arises, is there an arbitrage opportunity over here? So remember, anytime fair forward rate is equal to actual forward rate, that means there is no arbitrage opportunity available over here. In other words, if this is not equal, right? If this is not equal, say for example, fair forward rate and AFR is not equal, then there is an arbitrage opportunity. There is an arbitrage opportunity. Now over here, tell me which currency is going to be the key for you. Which is the currency which is going to be the key over here. Which currency provides us an opportunity to make some money? So what I can do is, here in this case, I can essentially take the forward contract at 84.5, right? And I know for a fact that fair forward rate future is going to be 85.49, which means there will be at least approx 1 rupee, which is going to be the margin, right? So I can always sell that in the spot market in the future if I want to have that particular thing available, right? Because actual forward rate banker is providing me at a cheaper rate compared to what in my opinion is the fair forward rate. So anyone, what do you mean by fair forward rate? Today, if somebody has to give me a fair forward rate, that is a year down the line, he will sell me, say for example, $1 at what rate? Then he is essentially going to offer me the rate of 85.49. But your banker is telling you, or the forex dealer is telling you, I will give it to you for 84.5. That means he is giving me 1 rupee cheaper, right? So here there is definite arbitrage opportunity available to be availed at the end, right? So you can essentially avail that arbitrage opportunity. All right. So that was an important aspect. So what will be your strategy for investment purposes? You could always gain from that particular strategy, because you know for a fact that if today I say, for example, borrow in US, I will be able to get it from the bank, as far as bank is willing to give me for just 84.5, and then I will sell it in spot in market, and I will essentially be able to make 100,000. If I am making, say for example, $1, then $1 pay 1 rupee, right? Approx 1 rupee is the arbitrage profit available. So that opportunity can be availed by us. All right. So now, before we go to the different modes of termination of forward contract, remember what are the different modes of exchange rate determination. So we have already discussed what are exchange rate theories: interest rate parity principle, purchasing power parity, which are important principles, right? Then we also have something known as exchange rate determination, meaning whenever you are determining the exchange rates, you need to be mindful of these 5 factors. What are these 5 factors? So first, exchange rate determination is whether you are having a deficit or surplus on capital or current account in your country vis-a-vis that particular currency, right? The other aspects is trade barriers. In today's time, this is a very, very important. You know, Mr. Donald Trump has been imposing a lot of trade tariffs, which essentially are nothing but trade barriers, right? So it is a hindrance to the free and open trade. So when you have trade barriers, obviously your exchange rate determination would that extent be more controlled, right? Then how much is the intervention by central banks? Now in India, earlier we used to have 100% controlled intervention by central banks. And now it's been long time since liberalization, globalization, that all the transactions on the current account are fully convertible, right? Meaning you can essentially take the positions openly in the market. You can buy currency, sell currency, of course, with certain terms and conditions as provided under FEMA. But now full Indian rupee convertibility is there on current account. On capital account, still restrictions apply, which are applied by the central bank, right? Then government controls. So government controls in terms of where I can raise finance from. So say, for example, if hypothetically government says that you cannot raise any finance from, say, for example, China or US or UK. Now, in this case, that essentially means you need to find FDI or your borrowings from countries which are other than these countries, right? Because government has essentially said we will not allow any FDI from these particular countries. So in that case, those are considered as government controls. And last one is obviously expectations. You have heard about something known as bandwagon effect, right? Where people are just following somebody else. If everybody is saying dollar is going to appreciate, then we also say dollar is going to appreciate. And as a result of that, we will incorporate that particular element in our expectations, right? So all these aspects play a role in your exchange rate determination, right? So those aspects will be there. All right. Now, how are the contracts terminated? Foreign exchange contracts terminated. So what are the different ways in which a forward contract may be terminated? So say, for example, this is the particular contract coming into being over here, right? So say, for example, I have a forward contract coming into being over here, right? So whatever is the, let's say the date is 1/1/2025. Okay. And this contract is for, let's say, 12-month period. In other words, it essentially terminates on 1st January 2026. So this is the forward contract which has come into being. Date of commencement being 1/1/2025 for a period of 12 months. Now, during this particular period, say for example, over here, this is the timeline 1/1/2026, right? So this is where your obligation is supposed to fall due. But before that, if I have received some money before the event, now try and understand, we have over here three distinct possibilities. What are those three distinct possibilities? Your contract may terminate on due date, or before due date, right? Or after due date, right? So your contract may terminate before due date, on due date, or after due date. If it is before due date, what could be the early possibility which is before due date? Yes, I may essentially say I am going to deliver earlier. What am I going to deliver earlier? I am going to deliver, say for example, I have a forward contract where I am supposed to give $100,000 to the banker. So I have a particular, say for example, a sale transaction over here. Okay, I have a sale transaction for which I will receive $100,000. Now, my client came to me, my customer came to me, and he paid me before the due date. So he paid me before due date. So now I have the money available, $100,000. So I obviously come back to the banker. I have $100,000. Why will I keep it? Because again, keeping it may require certain risk thereafter. So why take the risk? I just want to pay it back to the banker from whom I was supposed to deliver it. So I deliver it to him so that they will pay the money to me. Because I had entered into a forward contract that, say, for example, when I deliver the Forex $100,000 to you, then you will essentially pay me, say $1 is equal to rupees 82. This is what was the agreement. That a year down the line, I deliver $100,000 to the bank. Bank will give me 82 rupees. Now, before due date, I have received this $100,000. I want to pay this to the banker and close this contract. This is called early delivery, right? This is before due date, so it is called early delivery, right? Now, early delivery also means there is a possibility, because I am essentially going to enter into this contract is essentially getting terminated, right? I'm not able to fulfill this contract. Why do I say I'm not able to fulfill this contract? Because now, say for example, I have given this particular money back on 1st October 2025. So I am essentially trying to close this contract, but the bank has a particular exposure. Based on this, they might have entered into another exposure, right? Which is they will purchase $100,000 from me and probably they will sell it to somebody else. So they will essentially have to obtain another contract for these 2 months, right? So this early delivery also means there is early cancellation of these contract, right? So you have early delivery and early cancellation, right? I don't want this contract because I know my client will not be able to deliver in future. So this is early delivery where I receive money in advance and I try to come and close this contract. Then second is I know that my client will not pay in time, or I have already given him extension of 6 months, 3 months, whatever. So now I am doing early cancellation of this contract. There is also a possibility of me essentially telling this is situation 1, situation 2. There is also situation 3 where I might essentially say that my client has reached out to me and has said that there is going to be a delay and I have allowed him that delay of 3 months. So now I am going to say I want extension in the contract. So I'm reaching out to the banker for extension and I'm reaching out to him for extension before due date, right? Here. So early delivery, early cancellation, extension before due date. What happens on due date? If on due date, I essentially deliver $100,000, they pay me cash, transaction is done. So that is called termination by simple performance of the contract, right? On the other hand, if I cannot deliver, then in that case, what happens? Then in that case, there will be cancellation on due date, right? Because I fail to honor my promise, right? So this is my fourth situation, cancellation on due date. Five is obviously performance on due date. And then there is no problem. Everybody is happy, right? What can happen after due date? What can happen after due date? So there is a possibility that I did not apply for extension before due date, but now I learn that my client is not going to pay me in time. So I need extension of the contract. But this application I'm making after due date, right? So this is another way in which my original contract will be terminated by way of extension. So it is old contract will be closed, new contract will come into being with new maturity date or the new due date, right? So this will be your seventh situation. In fact, sixth situation will also be over here on due date, which is I ask for extension on due date. So you have extension over here before due date, on due date, and then extension after due date, right? Now, extension after due date is also known as late extension. All right. So now what will be the difference between these? Now remember, there is a contract which is entered into. So it's not like something which you have written with pencil and then rub it off. I have entered into a contract 12 months down the line. I have to deliver so and so. So that is non-negotiable, because based on that, there will be a backup contract which bank might have essentially taken with some other party, right, to cover their exposure. They might have another forward contract based on your contract. So now that you have agreed that I will deliver $100,000 on due date, there has to be $100,000 delivered on due date, right? So what happens when there is early delivery? So say, for example, early delivery is happening on 1st of October. Not be cancelled just like that, right? So what in terms of actual aspect happens is the bank is going to essentially now come up with a new contract for you. And what is that new contract going to be about? The new contract is basically about them as if they are going to sell the currency, right? So they'll have to cover for these 2 months because you are going to sell them currency right now. I have received the currency, so I want this money to be paid back to you. So they calculate whatever is their expenses for creating a new contract for this 2 months period, and then they will charge it to you on your early delivery and pay the balance amount to you. Again, remember, this original contract will still continue, and on due date, they will essentially have to honor the next contract which comes into being, right? So that is how basically they capture it. So just like in accounting terms, you cannot cancel it, right? You essentially manage with a debit with an opposite credit. The same way over here also, they will do the same way. All right. Now, let's take a couple of examples. Let's take a couple of examples. I understand we all have received the file of assignment, right? Where there are few practical questions on foreign exchange exposure and risk management. So we'll go through that, and then we will try to solve them, right? I'm going to stop sharing this file and go to the assignment file. Okay. So this is the file which we all have received, right? Let's read this question. On 1st October 2023, Mr. X, an exporter, enters into a forward contract with a BNP bank to sell $100,000 on 31st December 2023 at rupees 85.40 per dollar. However, due to the request of the importer, Mr. X received the amount on 28 November 2023. Please note the dates. To sell, the forward contract was for which date? Was for 31st December 2023. However, 28th November 2023. So this is a case of early delivery, right? Mr. X requested the bank to take delivery of the remittance on 30th November 2023, that is before due date. The interbanking rates on 28th November 2023 was as follows. So spot rate was 85.22/85.27 on 28th November, right? 1 month premium is 10/15. So how do you calculate this 10/15? 1 month premium basically meaning that 1 month later the price will be 85.22 plus 10 meaning 85.32 and 85.27 basis points plus 15 basis points. That means it will become 85.32/85.42. Okay, all right. Note, consider 365 days in a year. Prevailing prime lending rate is 12%. From the information given above, choose the correct answer to the following questions. The bank may accept the request of customer of delivery before due date of forward contract, provided the customer is ready to bear the loss, if any, consisting of, you have 4 options: swap difference, interest on outlay of fund, swap difference plus interest on outlay of fund, fixed charges plus swap difference and interest on outlay of funds. Yes, would anybody like to answer that? Tushi, would you like to try that? Tushi, Shailendra? Any of the students? No? All right. So the correct answer is point D, which is fixed charges plus swap difference and interest on outlay of fund. Fixed charges because bank is essentially going to have to do this entire transaction afresh. So they charge fixed charges for it. Plus swap difference because if there is any difference between your exchange rate, which was agreed to you on the forward exchange rate as on 31st December to the date which is agreed with you is 30th of November, right? So between these 2 dates, if there is any swap difference, you'll have to bear that particular swap difference as well. And interest on outlay of funds because they are paying you 1 month before time. So they are going to charge you interest on outlay of fund. You are told interest is at the rate of 12%, right? So 12% for the year, which means you'll have to bear for that 1 month interest on outlay of fund. Okay. Next question is, in case of early delivery, bank shall charge interest on outlay of fund at a rate not less than 8%, 10%, 12%, 18%. Now, as I already said, they are going to charge us at the rate of 12%, right? Prevailing prime lending rate, as it is mentioned, is 12%. So they are going to charge me at 12%, which is the option C over here, right? So the correct answer over here is D, and here it is C. Swap difference for USD 100,000 is. So here we will need to first of all calculate, right? The options given to us are 5, 20, 18 and 8. So how do we go about calculating it first and foremost? So remember, bank is going to sell you today at what rate? Bank is going to, now we are solving the third part. So bank is going to pay me as on 30th November, right? 2023. How much are they offering me? 85.22. Am I right? That is the rate which is being mentioned. Spot 85.22, 85.27. Remember, I have to sell dollars. So when I am selling, I will essentially receive the bid price, right? Not the ask price, bid price. So 85.20. Now, bank was originally obligated to buy at what rate? Bank was going to buy originally at what rate? Bank would have bought at which agreed forward rate? 85 point. What is the rate which was given to us? 85.40. Am I right? Bank will buy at what rate? 85.40? Yes? No. Now, what this basically means is bank is going to have to enter into a fresh contract to basically buy this $100,000, right? They will have to sell this and they will buy it at what rate? 85.42 in the market today. Try and understand this. They are giving you the money today. So 1 month down the line, had the bank essentially received this money, they would have essentially bought it from you at 85.32 and they would have sold it at 85.42. Am I right? So they would have essentially sold this at 85.42. Now, what is the loss? Loss over here turns out to be 0.20. 85.22 is what bank is selling today at the spot rate. And if bank is going to buy today, because the forward rate in the market is 85.42, right? So if bank has to buy dollars, then in that case, it will be at 85.42. So swap loss will turn out to be how much? 20 paise. Now 20 paise is per dollar, right? This is 20 paise per dollar. So you are having a transaction value of how much? $100,000, right? So into $100,000. So this turns out to be 20,000 ka loss, right? So the total swap difference is 20,000. So the correct answer should be B. Correct answer is B, right? Bank spot rate is 85.22. Bank will buy at forward rate at 85.42. So loss will be 0.20. So the loss turns out to be 20,000. Okay. Next is interest on outlay of funds shall be approximately rupees 92 payable by X, rupees 183 payable by X, rupees 183 payable by bank, or rupees 122 payable by bank. So we will need to calculate over here interest on outlay of funds. How do I go about calculating that? So if the bank is essentially on 28th November, bank is going to essentially buy at 85.22. It buys from customer otherwise at 85.40, right? As per the forward contract rate, that is 85.40. So what is the difference between the two values? That is 18 paise per dollar, right? Let me calculate over here. So bank buys at 85.40. This is the forward rate, right? This is the forward rate given in the contract minus what is the rate at which bank buys on 28th November. It will be 85.22, right? So what is the excess paid? 0.18 rupee per dollar. Am I right? Because forward rate is 85.42, 85.40. What you are buying, bank currently buys at 85.22. So rupees 0.18 is the difference. Now, you will also have to pay interest, right? So interest is going to be how much? Interest on how much? $100,000, right? Interest on $100,000 for 31 days. For 31 days. So how much will that be? How do I calculate that? Yes. Do I know that? Interest on $100,000 for 31 days. Yes. How do I calculate that? Calculate it as $100,000 into 31 days upon 365 into, remember what is the cost for me? The bank is paying you extra how much? 0.18, right? That is the difference which is there, right? Because not entire $100,000 is being paid out to you. What is essentially being paid out is the difference. Otherwise, the rest was already going to be paid into 12%. So how much does this come into? 100,000 into 31 upon 365 into 0.18 into 12%. So when we calculate this, it comes to rupees 183. Comes to rupees 183. Now this 183 is payable by whom? It will be payable by X, right? Because he is getting the money beforehand. He is the one who is liable to pay this 183 rupees because he is getting this alert. Next is net inflow to Mr. X is approximately 8542, 8520, 8519, 8540. Which of these amounts will be the correct answer? All right. So first and foremost, as per the forward contract, so as per forward contract, what he should have received is this amount, right? Because it was at 85.40. This is what he was expecting to receive, 85,40,000. But then now he has to bear certain loss. How much is the loss? We have computed that already, right? That was swap loss, which is 20,000, and then interest on outlay of funds. Now here there was no fixed cost in this question mentioned, and that is the reason we have not taken it, right? So now 8540 minus 20 is 8520, and so the correct answer should be 8519, 817, right? All right. Okay. Next, we go to the case scenario 2. This was the question on early delivery. Okay. Now, we go to the second question. In the second question, we are looking at an Indian exporting firm, Rohit and Brothers, exported goods worth of AUD 1 million to an importer in Sydney. Rohit and Brothers are worried about likely depreciation of AUD in near future, as it is likely that the export sum will be received after 3 months. So exported goods worth AUD 1 million to an importer in Sydney. And in other words, this is an Indian exporting firm, so they're expecting Australian dollars to come in, right? Which means they will be selling these Australian dollars to the banker. Rohit and Bros are worried about likely depreciation of AUD in near future, as it is likely that the export sum will be received after 3 months. Today, as such, there is no derivative contract is available in AUD to hedge itself from such depreciation. The following data is given. Spot rate is 56 per AUD. 3 months interest rate, India 12% per annum, Australia 5% per annum. From the information given above, choose the correct answer to the following questions. So which hedging technique can be used by Rohit and Brothers to hedge itself against the risk of depreciation of AUD? Options are forward contract, future contract, option contract, or D, money market hedge. Yes. Now, remember over here, there is one important line which is mentioned to you. And what is that? Today, there is no derivative contract is available in AUD to hedge itself from such depreciation. Meaning forward contract, future contract, and option contract are not available to you. The only option in that case left is money market hedge. So the correct answer in this case is money market hedge. Okay. Suppose if Rohit and brothers want to borrow some amount in AUD in such a manner that the receivable amount can be used to repay the amount borrowed along with interest. Can be used to repay the amount borrowed along with interest. The amount to be borrowed by Rohit and brothers shall be approximately. Now they are expecting how much to be received? 1 million AUD, right? Further, they are told Australia interest rate is 5% per annum. So if I borrow in Australian dollars today, what happens is I will have to pay them 5% interest for 3 months, right? So how much will that be? That is going to be, how much should I borrow in that case? 1 million. So I will get 1 million AUD, right? 1 million AUD multiplied by, I will have to, now this 1 million, remember, has to include the loan amount and interest. So in other words, this is 1 plus 5% is the interest, right? Divided by 4 because 3 months, right? So in other words, this will become 1 million upon 1.0125. So 100, your 1 million divided by 1.0125. If I borrow this much amount, right, that will take care of my obligation. You are told very clearly the amount to be borrowed by Rohit and brothers shall be approximately how much? So it will be 987,654 because as you can see, it has to be lesser than 1 million AUD, right? So here, even without calculating, I can essentially calculate. It is 987,654. So the correct answer is option B. Now, third option is, suppose if Rohit and brothers, third question that is, borrows a designated amount in AUD for 3 months in such a manner that the receivable amount can be used to repay the amount borrowed along with interest and plan to invest same amount in Indian spot market. The same amount available for investment shall be approximately. So first and foremost, if you are going to use the borrowing in such a way that it will pay off the interest and the maturity amount, that means we are already calculated that 987,654 AUD, right? And plan to invest the same amount in Indian spot market. The same amount available for investment shall be approximately how much? So you know for a fact that today spot rate is 56. So if I take this 987, I take this USD 987, 654 into 56. This is what will be received by me, right? So that will essentially come to how much? 55 8,624. So that is answer C. So if you convert that amount into Indian rupee in spot market, obviously you will get 56 rupees. So 987,654, right? So 987,654 into 56 rupees, you will get 553, 5.53 CR. All right. Suppose if Rohit and Bros borrows a designated amount for 3 months in AUD in such a manner that the receivable amount can be used to repay the amount borrowed along with interest. Further, he plans to invest same amount in Indian spot market. The amount obtained after 3 months of investment shall be approximately. Now, you have received dollars 987,654. You have multiplied that into INR, converted that into INR 553, and then you have invested this amount into INR, right? So the amount obtained after 3 months will be how much? So if I invest 553 for a period of 3 months, you will be earning how much interest? India is going to pay you interest of 12% per annum. So I'm essentially going to calculate over here. It will be 553 08624 into 1 plus 12% upon 4, which is nothing but 3%. So 553 into 1.03, that will come to 569. There is only one option over here available of that, which is D, right? 569, 67, 883. Okay. Now the fifth part, suppose if interest rate parity theory is held between INR and AUD, then forward rate between INR and AUD for 6 months should be how much? If interest rate parity theory is held between INR and AUD, so your current rate, spot rate is how much? 56, right? Into 1 plus, what is the interest rate? 12% upon 1 plus 5%, right? So that is 1.12 upon 1.05. So how much will that be? Let's calculate. So I do the calculation and the amount comes to equal to 56 into 1.12 divided by 1.05 into, now please remember, these 12% and 5% are for 1 year, right? So I should actually be taking half of it because we are going to calculate for 6 months, am I right? So I take 1.06 upon 1.025. So I get 7.91. Are you with me? This will be 1 plus 12% divided by 2, 1 plus 5% divided by 2. So in other words, it will be 56 into 1.06 upon 1.025. So this will come to 57.91, which is option B over here. All right, getting it, everyone? All right. Now, let's start with case scenario third. I hope these practical questions are helping you understand the concepts even better. Because when these concepts are applied in practice, that is when it gives you more clarity, right? All right. XYZ Limited, a US firm, will require pound 300,000 in 180 days and is evaluating different strategies to hedge against currency risk. The available market data is as follows. Current spot rate, 1 pound is equal to $2. 180-day forward rate is 1 pound is equal to $1.96. You can see over here, my spot rate is 2 coming down to $1.96, which means which currency is going to appreciate? Dollar will appreciate, right? And pound is depreciating. Pound depreciates. All right. Interest rates, UK 180 days. Deposit rate is 4.5%. Borrowing rate is 5%. US 180 days. Deposit rate is 5%. Borrowing rate is 5.5%. Option contract. Call option available on pound, expiry in 180 days with exercise price of $1.97 with premium of $0.04. Now, XYZ Limited has forecasted the following probabilities for spot rates after 180 days. So spot rate 1.91, probability is 25%, 1.95, probability is 60%, and $2.05, probability is 15%. From the information given above, choose the correct answer to the following questions. So first question being obviously the expected dollar amount needed if XYZ Limited does not hedge. So what is being told to us? If you do not hedge, meaning you do not take any cover, in that case, you will essentially have to pay whatever is the prevailing rate at the time, right? So how much dollar amount will be needed, because your obligation is 300,000 pounds. So US firm requires 300,000 pounds. So they will need to pay in dollars. They are not going for any hedging option. Remember, they are not going for forward rate. So they are not going to do forward contract. They are not going to do option contract. So what is the possibility in that case? Yes. What is the probable rate which is expected over there? Yes. What is the probability? So the probability over here is 1.91 into 25%, 1.95 into 60%, 2.05 into 15%. So we have 1.91 into 25%. So that is something like 40. Let me calculate that. Right? 1.91 into 0.25. So that comes to 0.4775. 0.4775. Next is 1.95 into 60%. So that is will be 1. This will be 0.4775. This will be 1.17. 1.95 into 0.6. So 1.17. And last one is 2.05. 2.05 into 0.15. So that comes to 0.3075. Total is 1.955. Total is 1.955. 0.955 into, this is the exchange rate, and I need how much? 300,000 pounds. So that is 586, 500. Do we have that option? Yes. D, 586, 500. 586, 500. Got it? Okay. All right. Now, if XYZ Limited chooses the forward contract option, the expected dollar amount needed in 180 days, the total dollar amount required shall be, that is directly the forward rate, right? Then I don't need to worry about it. 1.96 into 300,000. 1.96 into 300,000. So that will come to how much? 1.96 into 300,000. So that will be 588. Yes, 588. Under the money market hedge, approximately how much will XYZ Limited need to repay after 180 days? Under the money market hedge, approximately how much will XYZ Limited need to repay after 180 days? So what is the money market hedge options available over here? If I do a money market, borrow in dollars, right? Convert to pound, invest in pounds, repay dollar loan in 180 days. Am I right? Essentially be borrowing in dollars, right? So, because I need to pay pounds, I will essentially, wait a moment. So I have over here, so, okay, all. So I'm going to borrow in dollar, convert to pound, right? Then invest in pound. I will invest in pound. And then last is repay dollar loan. That is how my money market hedge will work, right? Because what will happen is I'm going to borrow in dollar terms today. I'm going to convert that into pounds. I will invest that for the stated period of 180 days. And the maturity amount will be meeting my obligation of 300,000 pounds. So that will take care of itself. And what I am left with is I have to only repay my dollar loan with interest, right? So what is being asked to me is approximately how much will XYZ Limited need to repay after 180 days. So I will need to obviously repay in dollar terms. So how many dollars will be required? That is what the computation is all about, right? All right. So first and foremost, I will need how much amount? I need over here 300,000 pound. This is the maturity value of the investment because that is what my obligation is, right? So for that, how much do I need to invest? Because there will be interest and then there will be principal which I will invest. So how much is that going to be? Now in investments, UK is paying me 4.5% interest, right? 4.5%. Remember, this is for 180 days only. So I will have to take half year basically, right? For 180 days. Oh, sorry, it is 4.5%. Very important. This is not per annum. This is UK is paying 4.5% for 180 days, right? So this is 4.5%. This is 100%, meaning total is 104.5%, right? That is what I need. So if 104.5% is 300,000, what will be 100%? By cross multiplication. So it will be coming to 300,000 into 100 divided by 104.5. I repeat, 300,000 into 100 divided by 104.5. So how much does that come to? That comes to 300,000 divided by 104.5. Right? That comes to 287,081. 287,081. This is the pound which is required by you to be invested today, right? So in other words, I need 287,081. Today, what is the exchange rate? Current spot rate is $2. So how much is the dollars required? I need 287,081. So how much is the dollar required at spot rate? Spot rate is 2, right? So 287,081 into 2. That comes to how much? 560, 570, 574, 162. 574, 162. This is the dollars which is required. Now, how much you will need to repay over here? This is what is being asked. So 574, 162 plus interest. What is the borrowing rate for US? US borrowing rate is 5.5%. So I'll pay 5.5% on 574, 162. $574, 162 into 5.5%. $574, 162 into 1.055. That comes to 605,741. That comes to 605,741. I multiply this with 1.055. So I get 605,741. Now let's check the options. Let's check the options. Do we have 605,741? Yes. B option is the correct option. $605,741. Now the fourth question. If XYZ Limited chooses the call option contract, after 180 days, the total cost in dollar for 300,000 pounds, inclusive of interest on premium amount, shall be. If you choose, that is XYZ Limited chooses the call option contract, after 180 days, the total cost in dollar for 300,000, inclusive of interest on premium amount, shall be. What is the call option? So you have option, call option available on pound is expiring in 180 days with exercise price of 1.97 and premium is 0.04. right? So in this case, you will essentially have to pay first and foremost, how much? You are looking at 4% or 4 cents rather. Premium is 4 cents, right? So 4 cents is the premium. If I exercise the call option, yes. So how do I go about it? All right. So in that case, what I'll have to do is, in the spot rates, which I am expecting over the next 180 days, so I will have a premium of 4 cents being added into the respective anticipated prices, multiplied with the probability, right? So I will get a fresh equilibrium rate over there. I will multiply that with 300,000 pounds, plus I will also have to pay 5.5% interest on 5.5% interest on $12,000, right? On which I will have to pay 5.5% interest in US. Borrowing rate is 5.5%, because today you are not going to pay anything. So that means you will essentially are taking this premium amount, which is to be paid upfront. You'll have to pay interest on that, right? This is 4 cents per dollar, right? So what you need is effectively $12,000, right? All right. So let's start. How do I go about calculating this? As I had calculated earlier, now I will have to add 4 cents as a premium on each of these options. So this is going to increase by 4 cents ka 25%. So it is going to be plus 0.03, right? 4 cents into 60%. So that is going to increase by 4 into 60%. So that is how much? 0.024. Here it has to be 4 into 25%. So that will be 4. So 1 cent. 1. This will be 1. Right? And then I will have over here 4 cents into 15%. So that will be 0.0 15% of 4 comes to 0.06, right? So my new rate over here, you can identify, will be 0.4 875 1.19 1.1940, and here it will be 0.3081. The total will come to, it should come to 1.99, I believe. 5, right? No, 6, 19, yes. So it is 1.996. All right. Now 1.996 So I am going to have over here 1.996. Okay, multiply that with 300,000 pounds plus 12,000 is the premium into 5.5% for 6 months. So that comes to how much? That is what we need to calculate. So 300,000 multiplied by 1.996 and then 12,000 into 5.5%. Just a minute. Okay, your exercise price is 1.97. So the spot rate over here can never be 2.05 in that case for me in the option. So the third option has to be reevaluated. Wait a moment. So how that essentially works is, just a moment. So here it will be 1.91, 0.91, 1.95, 0.95, and the third price is 2.05, but this is limited by the exercise price, which is 1.97. This is plus 0.04 plus 0.04 plus 0.04. So this becomes 1.95, 1.99, 2.01. Now multiplying with the probabilities, 25% into 60% into 15%. Here it is 0.48. This will become 0.4875. And 5. Here is 1.194. Third one is 0.3015. 0.3015. So that comes to 1.983. Multiply this with 300,000. So what you get is 594. 594,900. This comes to 594,900 plus interest 5.5% into 12,000. is 5.5% into 12,000 is coming to 660. 660. This comes to 595, 560. 595, 560. Yes, 595, 560. This is the correct answer. 595, 560. This will be 1.983. Okay. All right. Now, fifth question. The expected spot rate per pound after 180 days shall be approximately how much? So, here we will essentially calculate the spot rate which we have already calculated earlier, right? Which is 1.91 we had calculated earlier, remember? Here 1.955, right? So that is the expected rate which is probability wise expected. That is my expected spot rate 1.955, and the expected spot rate per pound after 180 days shall be approximately 1.955, meaning 1.96, right? So this will be the rate 1.96. Okay. All right. So with that, we have tried to cover maximum part of our chapter, foreign exchange exposure and risk management, right? You have a couple of other simple questions also, which is being shared with you. Try solving that, right? I will share the answers also later on so that it can be shared with all of you on the system. Try them. Yes, sir.
Actually, Amit ji, these are the answer. Basically these are the case scenarios available in the booklet. Okay.
Okay.
Students, so don't worry. These are the available answer anyway. Anyway, what we can do, we can also share the answers as well on the website. Okay. Don't worry.
All right, sir.
So if you want to devote some time, Amit ji, how many? Only one case scenario has been left, na?
We have two case scenarios left, sir. 4 and 5.
Okay. No problem. Since the time is short and topic was quite bit long, so no problem. Shunay will share the answer with you. I think this was from the past examination. One case scenario. Amit ji, just drag the screen downward.
I'm sorry, sir.
Just drag the screen. Just
Should I stop sharing?
no. Drag just down the screen.
Okay.
Yeah. Please down it. More.
This is case scenario 4, which is on Nostro Vostro account.
No, so just I want to see because I have adopted one question. Just down the screen, sir. Scroll down, please. Scroll down. Yeah. Case scenario. I think this case scenario 5th is from the past examination. Just I want to check it.
Yes, sir. Yes, sir.
Yeah,
This
na?
is from the past scenario.
Past. So okay, don't worry, student. We will share the answers. Okay, by today evening or by tomorrow. Okay. Student, thank you very much for attending the session. Now, basically, this session was basically a revisionary session for the topic of foreign exchange exposure and risk management that, as you have earlier referred the lectures, now it was sort of kind of a revision for you. So in any case, if you have any problems, so Amit ji, you can just type our email ID if possible for you.
Should I type your email ID, sir?
Yeah. Just
Okay.
bring on it Excel.
All right. So just a moment.
Yeah.
Sir, would you please dictate it, please?
SFM, sir, it is not visible. Screen is
Not
SFM.
visible?
Yeah. Now it is visible. Okay, sir. SFM dash final @ ICAI.in. And our contact number is 0120 3045
20.
303045 956. Okay. So Amiji, thank you very much for sparing your precious time and enlightening the student on this topic. Okay, student. Now we will see you in the next reasoning class. Thank you very much and have a nice day. Thank you.
Thank you, sir. Thank you very much.
Thank you.